And happy Friday, everyone. Welcome back, Market Rebels, and to all of our live streamers out there. And it would have been a much happier Friday if our SPY could have held up. We had our two candle break of the 50-day moving average yesterday, so that was looking pretty promising. And then today we pretty much gave it all back, although it looks like we did have a tiny bit of a rally going into the close, but still down about 1%. But we'll have to see how that shakes out for next week, but certainly points to more volatility in the markets. And that's a lot of what we talk about here, at least lately on Trading Tune-Up. So if you've been with us for the past few sessions, we talked about vertical spreads. And in one of the presentations, I said that we don't ever want to do a credit spread just because of the word credit. And yet that's the reason that most people put these on. But then it brought up the question, well, when would you use a credit spread? They're not necessarily bad, they're just a tool. So what are some reasons for using them? And that's what we've been talking about this week. So on Monday, we talked about the first of our key reasons, which was skews, which are mispricings that can occur in the market. And if those occur, it might make us lean towards a debit spread, might make us lean towards a credit spread. Yesterday, we talked about reason number 2, which was the ease of the morph. And so recall that a morph is just a change to the risk graph. Maybe we leg into a vertical spread would be a type of a morph. We're just changing the overall shape. And so depending on what we think might happen for our plan B, let's say we think maybe the stock is going to break out into take off like a rocket, maybe we want the debit spread. Maybe we think it's going to bump into resistance and actually reverse, in which case we might opt for the credit spread if we're thinking about morphing it. So that would be a reason for choosing one over the other. Today we're going to talk about reason number 3. So what is that? Well, that is vertical spreads and early assignment. So I think everybody knows when you buy a call or buy a put, you have the right to exercise. It's always the buyer that has the right. But if you sell an option, you've got some type of an obligation, which is just the opposite of the buyer's right. And so with a vertical spread, we've got a little of each. We've got a long position and a short position, and that means it is possible for you to get assigned early. So when it comes to call options, pretty much the only reason you would ever exercise a call option early is for a dividend. That doesn't mean that's the only reason that people do it. People make mistakes. But if there's a dividend in play, you could certainly expect a potential assignment. For put options, it's usually if the put option goes deep in the money, delta's pretty close to -1, and it becomes an interest earning play. So in this market, that would be fairly rare. But we're going to look at what can happen with early assignments. And is that going to make a difference in the spread that we choose? So let's go have a look. So let's start off with the vertical spread. This is a 100-105 vertical. We've got our bend here at 100 and at 105. Those are the two strikes. So this is the expiration graph. This is what we look like going right into the final seconds of expiration. But remember that today's curve doesn't look like this. It might look like this. We read it the same way. We pick a stock price, we trace a line up to it, and it will show us the value of that call today. But as time goes by, technically as every second goes by, but certainly every day that passes, this line shifts a little bit. So let's advance the clock maybe a couple of days. We might see this. A few more days, it moves to this, and we keep slowly marching towards that black line. Now notice what's happening though. On the left-hand side, the curve is moving down. This is our area of negative theta. That's why that's decreasing. And it's also positive gamma. Over on the right, we get the opposite. We're seeing that it's increasing. This is positive theta, which means that the value of this spread is going to increase just from the passage of time. It's also negative gamma. So depending on what we think is going to happen with the stock price, depending on the risks that we want to take, depending on volatility, it could make us lean towards putting the vertical spread in the money or out of the money. And that can certainly change things. It can also change our probabilities for early assignment. So for example, I showed this in an earlier tune-up, but let's say that the stock is at 100 and we have the long 100-105 vertical. All right, so this is where we are long the at the money strike and we're short and out of the money. Notice what happens if we have fairly low volatility. At 20% volatility, it's the cheapest spread. This blue line over on the left doesn't sit as far down, and it creates the maximum, a much higher maximum gain. And that's because it's low volatility. We've placed ourselves into a situation where it's out of the money. It's relatively speaking unlikely to happen, and so it's going to produce the largest gain. It also means it's the riskiest of these. If we have higher volatility, let's say at 80, it's going to be more expensive. We're going to pay more for that vertical spread, but we have a better chance of making that money. And because we paid more over here, it's going to produce less. So depending on the volatilities, it can make us lean towards putting the spread in the money or out of the money. So watch what happens if we flip it, if we go in the money. These colors are going to reverse. We're going to see that the 20% is on bottom and 80% is on top. See, now we're buying the 95 strike and we're selling the 100. So we're both options, well, the long option's in the money, the short's at the money. So we don't really need the stock price to move, and this is going to start growing. It's going to be positive theta as we get closer to expiration. But look what happened. Now the 20% volatility is the most expensive. Before it was the cheapest, and that's because it is far more likely for this stock to sit at 100. So because it's more secure, people pay more for it, and therefore it produces a lower maximum gain. If we put this spread on with 80% volatility, even though we're selling the at the money option, not a real good chance that it's going to sit there because the volatility is so high. So now that becomes the risky one. So that produces potentially the largest gain, but it's also going to be the cheapest. So these are some of the things that you have to consider with the volatility and the risks you're willing to take and your outlook. As I've talked about, options are multidimensional. There's a lot of considerations that you have to put into these. But this can make us lean towards putting a spread in the money or out of the money. So let's take a look at what can happen once we've made our decision with early assignment. Let's start with the debit spread. Let's say that we buy the 100-105 call spread. We're going to buy the 100 call. We're going to sell the 105. Let's just say it's a net debit of 3. And the question that we want to ask is, what happens if we're assigned early? Now, the only option we can be assigned on would be the short 105 call. It's the short option. But I want you to notice something first. Notice we talked about pricing principles a couple of weeks ago. We are in possession of the more valuable strike. Lower strike calls are more valuable. This is a really interesting insight. And it's important when we're setting up the strategy. We are in possession of the more valuable option. This becomes a potential obligation for us to sell at 105. But if we buy at 100 and sell at 105, who's complaining? It's 5 points. That's the most we could ever make anyway. So the thing is that this now becomes a guaranteed sale if we're assigned early. See, when we first sold this call, we're going, I don't know, am I going to get assigned? Am I going to sell it at 105? Not sure. But once we get assigned, it's no longer a situation where we might sell. It's now a guaranteed sale, and that means we have been given our guaranteed maximum profit early. All right, so there's really two things that are happening. It's guaranteed, and it puts us at the maximum gain early. It's a huge, huge benefit to be assigned early on a debit spread. And again, that's because we own the more valuable option. Now, one thing is to notice that it will change the directional bias, and this is different from our morph. Remember in the morphing class yesterday with the debit spread, if you morph it, you stay in the same direction. But if you're assigned early, you're going to flip. Lots of things that you have to consider. So this is going to change our directional bias. So let's go find out how. Here's our long 100 call, short 105. We paid 3, max gain of 2. If we get assigned early, and the only reason that's going to happen is that the stock is up here somewhere, because it means that the 105 call would have to be fairly deep in the money, or potentially maybe a surprise dividend is announced, but it's certainly going to have to be in the money somewhat. So we're going to be up in this area. So what happens when you're assigned? The short position just vanishes. We don't have to do a thing. We don't have to close it. That's what it means to get assigned. We have fulfilled our obligation. What's next? we have to sell shares. Well, if we don't have the shares, we're going to short stock at 105. What happens now? Well, we are short stock up here, and we're long the 100 call. We just retained that, and that is synthetically a long $100 put. This is why we flip. But notice that we have a guaranteed sale at 105. So if we paid 3 and we've now guaranteed to sell for 5, what does that mean? We've locked up $2 in our pocket. So we go to this. All right, so there's our guaranteed $2. We flip from bullish to bearish, but we have an out of the money put, but we have the potential for unlimited gains. So if you are assigned early on a debit spread, there's a number of things. You get your maximum gain guaranteed, you get it early, you get unlimited gains, whereas previously you had limited gains, but they're in the opposite direction. So sometimes we look at this as saying, listen, when you put this spread on, the best you could hope for was a $2 maximum. Now you got it guaranteed, but we also gave you a free lottery ticket. You might as well just hold on to this until expiration and maybe get more. This is the only time you can actually make more from a vertical spread than the difference in strikes. So it's actually a huge benefit, and too many times traders are fearful of early assignment. This is why you have to understand your options and what could possibly happen. So that's the outlook for a debit spread. Do we get the same outcome for credit spreads? And in particular, are we going to lock in a guaranteed gain? Now remember, the whole hype was, for most people, credit spreads, because we get paid for it. As we found out, that's not true. But if we get assigned early on a credit spread, are we going to get the same benefits? Well, let's go check it out. Let's say that we sell the 100-105 vertical, same strikes that we looked at before. We're going to buy the 100 put, sell the 105 put. Notice we are selling the more valuable strike. We are giving that to the buyer. And that buyer now has the potential to force us to buy at a disadvantageous strike. It's an advantageous strike for the seller to sell high, but it's disadvantageous for us to buy at 105. So you have to understand these. Let's say we get a net credit of 2. So again, what happens if we're assigned early? For a credit spread, you are going to unlock those gains. That's something positive that comes out of it. You're going to maintain the same bias. And again, that's opposite of the morph. Remember, on a credit spread, we would switch from bullish to bearish or bearish to bullish. For early assignment, you're going to keep the same bias. But we do not get any guaranteed profits, and we maintain the same maximum loss. So there's not really any major benefits other than that we've unlocked the gains. And again, the reason for this that's happening is all has to do with the most valuable strike. We have given that away. When we put this spread on, we're going, you know what, I might have to buy shares at 105, which should be buying high. Well, now we just did it for sure. Didn't really change anything other than the timing of the cash flows. There's an interest component here, but it's a very small difference. The fact is we have to buy now at 105. So here's our spread. Credit of 2, max loss of 3. Stock is going to be down here before this long put exercises. It's got to at least be in the money, and typically has to be quite a bit in the money, usually delta near -1. But if that happens, the short 105 put goes out of our account. That's what happens on an assignment, and we are now long stock at 105, right? When you get assigned on a put, you have to buy it for the strike. So we've now purchased stock at the disadvantageous price of 105. We have the right to sell it for 100. That's still a 5-point loss. See, it was different with the debit spread. It locked us into a gain. Nothing really changed here. And that's because we gave the advantage to the buyer, person who bought that put. So now we're long stock. We're long the $100 put, and that is synthetically a long $100 call. Notice that we are bullish before, and after we get assigned, we're still bullish. We've got an out of the money call. So in one hand, we've unlocked the potential gains. That's really the only positive that comes out of it. But we still have our same max loss. That hasn't changed. And again, here's our unlimited gains. So in a sense, you have to say, really, what big benefit did we get? We've unlocked the gains, but it's a far out of the money call. So didn't really do us a lot of good. And so that's one of the negatives for a credit spread, is that if you get assigned early, it's not really going to do you as much of a benefit as if you have the debit spread. So if early assignment is a concern, debit spreads, you're going to receive your guaranteed maximum gain, and you will get unlimited gains, albeit in the opposite direction. Credit spreads, you get unlimited gains in the same direction, but you get no guaranteed gains and your maximum loss remains the same. So again, what I like to show here is that these aren't easy to see. And option success depends on seeing opportunities and risks. So once again, I want to ask everybody who's watching here, did you see these differences? Did you see the benefits? Did you see the potential risks? Did you even think about it? Did you think about skews? Did you think about morphs? Did you think about early assignment? And this is just kind of knocking on the door for the various reasons why we might choose one over another. But these are three of the big ones. And if you're not seeing these, this is where a coach can really pay dividends. So as always, we like to invite everyone, no pressures at all. It is up to you. You're the only one who's going to benefit from it. But you can get a free 30-minute one-on-one coaching session, really topic of your choice, from one of our world-class coaches. And the phone number there is 815-957-9125. So I like to really push our coaches. I've had conversations with all of them, absolutely mind-blowingly cool experiences, floor traders for decades, market makers. They can definitely help you with your trading. And so as always, this is a risk-free investment, and that can certainly never hurt. So I hope that helped. That was a little kind of a fun week there, a little tour of some various reasons for choosing a debit spread over a credit spread. And I hope that helped. And I want to wish everybody a fabulous upcoming weekend. We hope to see you on Cocktail Hour at 5 o'clock. And we'll look for you on Monday for a brand new topic at 4 p.m. And we hope to see you then. Take care. See you then.